Welcome to the Grow Your Business and Grow Your Wealth podcast with Gary Helt. Gary is an expert in helping business owners put together a plan that will provide a better future for their businesses, themselves, and their families. On the podcast, Gary interviews other professionals who share his vision, and together they share secrets and strategies any business owner can use to build a better financial foundation for your business and your life.
Welcome everyone to the program. Today we are honored to have Mr. Chris Coolidge with us. Chris is the Chief Investment Officer with our partners at Brookwood Investment Group. Chris is an 8-time PSN Top Gun Award winner and the 2025 Philadelphia Titan 100 honoree. Mr. Coolidge is one of the top certified financial analysts in the country, and as Chief Investment Officer for Brookwood, he oversees the design, implementation, and stewardship of multiple proprietary investment strategies with established performance track records. He is responsible for portfolio construction, risk management, and investment decision-making across complex client mandates, while setting firm-wide investment philosophy and outlook. Mr. Coolidge regularly authors and communicates market insights and strategic perspectives to clients and stakeholders, in addition to speaking to the media. Chris, I have to tell you, I've been wanting to do this interview for some time now. Our clients love what you're doing for them, and they don't even know you, right? So I want to change that. Thanks for joining us today, okay?
Yeah, hello, Terry. Thank you for having me. I appreciate being here.
Oh, my pleasure. So Chris, could you start by, giving us a bit of your background and what led you into the investment world?
Yeah, absolutely. I started my career at BlackRock in 2000 when BlackRock was a very, very small firm relative to what it is today. Less than 500 employees, 170 billion in assets under management.
And you built all that?
Yeah. And I spent 10 years there kind of learning the traditional approach to asset management. I really learned a lot about obviously portfolio construction. I was in a customized group where I really spent a lot of time designing portfolios for clients that had very unique needs or different types of customized solutions that they required. After 10 years at BlackRock, the firm grew to, I believe, about 9 trillion and 11,000 employees. Very, very different firm than what I started with. So I decided to leave there and joined a firm called Brandywine Global Investment Management. Brandywine Global is kind of more of a global macro, absolute return oriented firm, but very non-traditional in terms of their approach towards investing. And I really got a lot of experience looking at different asset classes, not just your traditional stock and bond markets, but commodities, currencies, emerging markets, developed markets, looking at everything across the world and just kind of looking at how all those different asset classes and different sectors really kind of interacted and intertwined with each other. And I really started to kind of adopt that framework of kind of a non-traditional global macro approach towards investing. And I spent 6 years at Brandywine Global and decided to leave. I joined up with 2 other ex-BlackRock portfolio managers, and we launched our own firm and our own hedge fund. I was a long-short multi-asset hedge fund, just applying that philosophy and that framework of really kind of starting at the global macro level, 30,000-foot level, drilling down into all different asset classes and positioning portfolios that way, looking for obviously the best ideas and opportunities within that space.
Gotcha.
After a couple of years, we won our civil raise, and I've been in the chief investment officer role for Brookwood now. So very, very excited to kind of be partnered with Brookwood. It's been a great relationship so far.
Awesome. When I think of Brookwood, 3 words come to mind. There are much more than that, but these three initially come to mind. And that's boutique, culture, and creative. For some reason, those words come to mind. So what ultimately led you to Brookwood?
Yeah, I think those 3 words are actually paramount in terms of what I look for in terms of a firm and obviously what we're trying to build at Brookwood. It was in November of 2021 that I met Kim and Bob Raimondo, the co-founders of Brookwood. Just having a conversation with them, I ultimately started sub-advising for them, but got to talking with them about their vision, what they're trying to build, and really where Brookwood will be in 5 to 10 years. And it was those conversations that really had me thinking with my experience and kind of customized portfolio solutions and that institutional experience. Really, it made sense for us to combine forces and really try to build something special together. So we do look at, in terms of a boutique. I love that feel. I kind of love that small firm feel. Obviously, I've worked, my story at BlackRock and starting with there as a smaller firm, and watching it grow to obviously 11,000 employees was just something that was crazy to me.
Yeah, you
But
became a
I love,
number, huh?
yeah, I love the smaller feel, that closer kind of like interaction and kind of cultural alignment. And the culture here is very, very important to us. We're building teams and partnerships between our employees, our advisors. It's very important to us.
Mhm.
And culture is one of the number one things that we really consider to grow forward and move forward, that we have a great cultural base.
You mentioned institutional. I brought a thought to my mind. Uh, it's amazing what we've been able to do by bringing institutional and private market opportunities to Main Street, just by restructuring and doing some unique things. Can you touch on that?
Yeah, so I think with the institutional space, obviously they have access to a number of different, whether that's private funds or private styles, or commodities, currencies, things that you just don't actually or haven't had access to in years past. And I think, even in the last couple of years, we've had so much innovation, particularly in exchange traded funds or
Mhm.
ETFs. In that market, there's been so much innovation, that we now have access to different strategies or styles that we can incorporate into our portfolio management process and our approach. And I
Okay.
think that's one way that we're looking to really bring this institutional, more modern approach to portfolio construction to the wealth management space. And I think that's very, very innovative for us.
Cool. Well, walk us through what Brookwood does today, if you could, and just as importantly, why we do it.
Yeah, I think what we really want to do is design, portfolios that have really more durable outcomes across, all the market cycles. And it's very important that we can navigate through market cycles, because we've had a lot of volatility this year, last year. I mean, we had a number of different drops in the market, a number of different rallies to all-time highs. So being able to navigate through that and kind of blending our traditional exposures with, strategies that are, more accessible to, private or institutional settings that are now available to us, blending that together is really helping us navigate, the highs and lows of markets. And it's more of like a modern approach. We've come to, obviously the markets have been more complex, the correlations have shifted. It's a really, really different environment, even than what it was 5, 10 years ago. So what we're doing is really, that institutional approach is really helping us to kind of adapt, evolve, and really help our clients and our advisors navigate through all these changes and volatility.
Can you touch on how tactical management fits into that?
Yeah, absolutely. So when we say tactical, what we really want to do is kind of anticipate market changes, or anticipate moves in markets or changes in sectors where we want to allocate, versus being reactive. We don't want to be reactive where, oh my goodness, the stock market just sold off 5 or 10%. We need to sell and get out. That's really what you're doing, is locking in losses. It's a knee-jerk reaction. We want to be tactical and anticipate. We do our best to try, and we're not trying to time the market, but we're just trying to anticipate where, we think something is very overvalued. We kind of want to move away from that, find something that's maybe cheaper or more attractive. And that way is really helps us through kind of the highs and lows of the market cycles, really being tactical and looking for opportunities and moving away from the ones that we think are expensive or overvalued.
I think one excellent example of that is what you might have done towards the end of December and in the first week of January when it comes to silver. Can you touch on what happened?
Yeah, so our liquid alternative strategy was really, it's a part of our flagship strategy. We have a very heavy focus on industrial and precious metals. We're allocated to gold and silver, platinum, palladium, copper, for example. And so looking at silver had a really strong run. It was up, I believe, almost 100% over the course of like almost 15 months. Very, very strong run. So it was just, to us, had been very stretched. We saw a lot of institutional money, leveraged money, hedge fund money, and then retail money start to really flow in. And so that extreme like push of AUM flows into like the funds and so forth just pushed the price of silver per ounce at a very high level. We saw it just spike straight up,
Mhm.
and that was a time for us to say, we need to get out. We want to reduce our exposure. and kind of take some profits here. So that was a way of us saying, hey, this looks overbought to us. It's really stretched. We took profits, and not long after that, the silver market dropped. I think it was
Yeah, it
almost
was like
$50 an
January
ounce.
9th or 10th, and it dropped like 50% in no time at all.
Yes, it was
It
a
was
precipitous
crazy.
drop for sure.
Yeah. So, all right, cool, cool. Can you give us an overview of the models and how they're structured?
Yeah, absolutely. So I'll start with our flagship strategy that I just mentioned. We have a more modern approach to our flagship strategy. It's a balanced strategy. So it's really, right now, it's split 50% in equities, 30% in liquid alternatives, and then 20% of fixed income. So it's more of a modern approach to your traditional 60/40. And we think that that kind of liquid alternatives component really helps to diversify our clients' source of return. Obviously, it gives them another source of potential return for them that can help, as we mentioned before, be tactical and navigate through a lot of these market cycles. And a lot of times being exposed, like right now, within that liquid alternatives exposure, we're invested in commodities. And a lot of times with commodities, if you look back even to the 70s or sometimes in the 80s and late 90s, when stocks and bonds were both kind of selling off, commodities actually had positive returns. And it's that type of relationship where you have zero to low correlation with traditional stock and bond markets. That opportunity really helps to drive through different market cycles. So
The dynamic liquid alternatives did pretty well last year. It was like 70% or something like that.
yeah, the calendar return 2025 was 70%.
Okay.
So we're excited about that strategy. It's been helping to boost our clients' performance, but it's giving them again that kind of that low to no correlation, diversified source of return. We think that there are opportunities in that space to really kind of boost performance over the next 3 to 5 years.
Yeah. One of the things I've noticed is, we've consistently beating the benchmark indices for the most part. And I'm going to assume that's probably a lot to do with our tactical management. But, people look at our return streams and sometimes assume that, we have to be taking excessive risk to get there. And that's not the case at all. Can you explain that a little bit?
Yeah, absolutely. So, I'll give an example within the equity space. We made changes. We're talking about being tactical. Last year, we were allocated to large cap growth, particularly like the Mag 7 or the mega cap tech names really had a strong run in 2025. And names like Nvidia, Microsoft, Apple, really, really strong stocks. They're just, in my opinion, became very, very overvalued. They were pricing in, 10 years of 20% growth. It's just beyond price of perfection, for some of these stocks. We decided to move out of large cap growth to some degree, reducing that exposure. We moved into small cap stocks, just as an example. And then the first quarter of this year, the market sold off because of what was happening in the Middle East. The large cap names really got punished the most,
Hmm.
but small cap stocks actually had positive performance. So that's just an example of kind of like rotating out and anticipating our opportunities where being tactical and kind of moving out of something that we feel is overvalued, and small cap stocks were kind of beaten up. We thought there was an opportunity there, but that helped to kind of boost performance. But also within our equity exposure, we are invested in ETFs. The innovation, as we mentioned before, in the ETF space has really come a long way. We were invested in in the first quarter of this year in long short equity ETFs and actually hedged equity ETFs. So kind of having that more defensive posture helped us as we kind of went into the Middle East crisis. We weren't anticipating a war in Iran or anything like that, but we just felt that it was time to kind of get a little more defensive, be protective, and try to protect downside risk as much as possible. So that really helped us in the first quarter to outperform.
Mhm. Yeah. You've spoken, and we have spoken about super cycles and these mega trends. What are you seeing today that investors should be paying attention to?
Yeah, I think there's a number of different forces at play here. They're all kind of converging at once, I say, but you've got the evolution of technology, artificial intelligence,
Mhm.
automation, and obviously the build out in these AI data centers have become, kind of their own theme, we'll call it. Then you've got, this kind of changing nature of global supply chains and resource demand. That's really like we used to be fully globalized across the world, and everyone was kind of intertwined in terms of that supply chain. Now we're starting to see the supply chains just split apart, become more regional. So that's really changing a lot of like resource demand, natural resources, obviously oil, and other supplies have just become, everyone's trying to secure their own supply chains.
Mhm.
So that's influencing everything from commodities to infrastructure. And then it's just really this broader shift in how capital is allocated. We talked about before about the innovation, but the innovation in the ETF space now is that you're getting greater access to strategies that were, previously like limited to just institutions.
Mhm.
But now, the individual investor has access to things like a private equity ETF, which, it's fantastic for them. They're getting these new return streams that they didn't have access to before. So I think, to answer your question, the key is really it's recognizing that these trends are taking place and then trying to position portfolios, that can participate in what's happening and it's being still able to manage that risk.
Can you talk briefly about what you are doing specifically and what Brookwood is doing specifically to take advantage of those trends?
Yeah, it's, with
And I'm
we
referring
have
to the Aurora and the liquid alternatives. Yeah.
Yeah, we've designed some strategies. So we've got, I'll touch on three strategies. The first one, as you just mentioned, was Aurora, which is it's a thematic equity strategy. It's really focused on the next generation of AI. So who are the next beneficiaries after the Mag 7, after NVIDIA, Amazon? They've obviously had a really strong run in performance, but who's next? Who are the enablers and the adopters of artificial intelligence that are going to really, implement them into their business model, into their practices, and then really start to thrive? We're seeing companies like ServiceNow and Salesforce that are starting to really implement that. But also, this thematic equity strategy is going to look at supply chain, humanoids, robotics, areas that are really going to start to develop and really flourish from this change in AI and the implementation of AI. So that thematic equity strategy, it's, very excited about that because it's one that it's kind of an early stage, the second revolution of AI that we're seeing. And it's really starting to really, gather some steam. We have another strategy, our liquid alternatives, which we talked about. It's really getting exposure to right now to commodities. And we think that supply to demand imbalance in commodities, there's just not enough supply of certain
Mhm.
industrial and precious metals versus the demand that we're about to see. And that demand's coming from a number of different sources. It's, obviously for AI data center build outs, but also just other, military construction, you name it, even solar. Silver is very huge with solar and solar panels. So you need a lot of silver for that as people look to kind of diversify their sources of energy. But also in that strategy, we're looking at a couple other themes. One is the AI data centers and their need for energy.
Mhm.
You look at some of these AI data centers and they need so much electricity to power and cool these massive buildings. They're really trying to source a number of different things through either nuclear or solar or other types of natural gas supplies. So we've kind of invested in that. And then we most recently launched our third strategy. I call it a multi-strategy model. But what we're trying to do for our advisors their clients is give them access to these private fund styles that have typically been very difficult to get in. They have very high minimums. There's a lot of paperwork involved. They can be locked up for several years. Some of them have 7 to 10 year lockups. But now the innovation in ETFs has really given advisors and their clients access to these institutional strategies. And we put together a model of all the different ETFs that have launched. Many of them are very, very new, but they're giving them exposure to hedge fund styles, to private equity styles, private credit, multi-strategy, managed futures, CLOs, a lot of different things. And we put a basket together for our advisors and clients to really give them that institutional exposure, but a very, very different return stream. It's not going to behave like the stock market. It's going to be very, very compelling in terms of the return stream. So we're excited for that one.
Yeah. You've been doing a great job, and I'm excited too. And I'd like to talk all day, but I don't want to overwhelm our clients the first time they meet you. So, as we kind of wrap up, what's the key takeaway that you'd like investors and advisors to be left with?
Yeah, I really think, the investment landscape has evolved. That's probably one of the important things to really convey to clients. The traditional 60/40 was built for a time many, many years ago. And the traditional 60/40 it's not working like it used to. I mean, we look at 2022, it was a year that was probably one of the worst in 100 years for that 60/40 allocation. 60% equity, 40% bonds. You typically think like they would support each other. but a lot of times they've really been trading in the same direction.
It's not the same world it used to be.
Correct. The first quarter of this year, the 60 was negative because both stocks and bonds were selling off. And I think now, like the more modern approach to portfolio construction for our clients is really paramount now. Having that modern approach with, access to alternative strategies and alternative return streams, it's going to make, obviously client portfolios more flexible, more meaningful, but we're really focused on navigating and long-term trends. So, we really want to provide those solutions for clients and advisors, but being innovative and taking advantage of the innovation, but being very outcome oriented as well.
Yeah, I find it kind of ironic that, and I agree with everything you say, but I find it kind of ironic that the brokerage world are still playing by that old outdated 60-40 playbook. I haven't got it yet.
It's surprising. We're seeing a very, very slow shift, but the adoption it's not there yet.
Yeah,
So.
yeah. Well, Chris, these are some really awesome and great insights. I want to thank you for taking time out of your schedule today to join us and help us out with our clients. I mean, you're doing a tremendous job, and just keep it up, please. All right.
Yeah. Thank you, Terry. I appreciate you having me. I appreciate the conversation.
All right. You take care now.
Take care.